Okay, I'm sorry. Well, I had accidentally muted the mic. If you can hear me now, can you can you please put a yes in the chat? Okay, great. All right, well, what we're going to be doing today is reviewing our unique way of trading credit spreads. Now we just closed a credit spread today for a really large amount of profit. I'm going to go over our track record with you. And I have two formatted credit spreads that are going to be going out. Normally they would be going out on Sunday because there's no market on Monday because of the holiday. They're going to be going out on they'll be going out on Monday evening. The flagship newsletter goes out every Sunday. I sent out innumerable updates, and we've really negotiated through a really choppy market and gotten about an 85% win rate. And to show you exactly how we do it. Now, just look quickly, this disclaimer that all signals and trading opportunities that we provide are for demonstration purposes, educational demonstration purposes only. We're not acting in the capacity as money managers. Everyone should understand that trading involves substantial risk, and a person loses a substantial amount of money. And I always tell all my traders, never risk more than you can afford to lose. Now, just a little bit about myself. Here's the Right Line Trading team, which is growing really quite significantly. And just a little bit about myself. I'm a graduate from an Ivy League university. I went to the University of Pennsylvania for 8 years. Unfortunately, Penn had some notoriety lately with its president testifying before Congress. Back when I was at Penn, these were not issues. As I said, I was there for 8 years, and I majored in applied mathematics. I graduated summa cum laude with honors. I was inducted into the Phi Beta Kappa Honor Society, and it was always my goal in life to go into teaching. I applied to a number of academic institutions, excuse me, and ultimately I became a full-time professor at Thomas Jefferson University in Philadelphia. I had established myself there. I made a lot of friends. I wanted to stay in Philadelphia. On the While Jefferson, I published 15 peer-reviewed articles in top-tier journals. I was a full-time professor. I taught an enormous number of undergraduate and graduate students. I did an enormous amount of research. I've always had the mindset of a scientist, a teacher, and an academician. I've been an invited guest speaker in many countries internationally and in many cities domestically. Now, the goal in trading is to generate consistent income in our market using credit spreads. And what I'm going to do is I'm going to share with you the way we do that. Now, the important thing to know is that jumping between strategies instead of focusing and mastering any particular one, especially when it comes to options, in fact, specifically when it comes to options, is really a mistake. Now, I have a number of alert services. This is one of them. In my humble opinion, there's only two ways that you have to learn how to trade options. Every other way is simply going to degrade the ultimate amount of money that you capture in any particular week, month, or year. And the reason we fight for percentages on every trade is because when you compound those percentages over a yearly basis, I was in the process of making a slide on that. I just didn't have time to finish it, but it amounts to an enormous amount of money. Now, those two strategies are either buying calls or buying puts or selling options and trading credit spreads. I believe that buying spreads is a very, very harmful strategy. Every now and then we have to do it. Every now and then there may be a particular type of trade that requires it, but 99% of your trades are going to provide you with a minimal amount of risk and the best reward on just trading a naked call, naked put, or selling a spread. Now, what you want to do is you want to have a strategy that works consistently. And so you gain confidence. Now, on the slide that I created, you only need to win 50% or more of your trades. But what you're going to do is you're going to win 85% or more of your trades. And our strategy prevents blowups. We have specific stops on the trade, and we know the maximal risk that we can accrue when we take the trade. So even if we take an occasional loser, and we do, it's not going to put a dent ultimately in our profit curve. We're going to just keep rolling along, and we're going to win 85 out of 100 trades. Now, when you trade credit spreads, it's a very, very simple and very forgiving strategy. And in a market like this, it really provides you with a lot of security. Now, it's an income generating strategy when you have a mild directional view on a stock or on an ETF. This strategy is very forgiving. I'm gonna show you why. Now, I always hear other traders, other people selling software programs, things like that, telling you can make money in it even if the market moves up, down, or sideways. Well, this is the type of strategy where that is operational. Now, obviously, you want the trade to go in the direction that you predict, but if it moves against us, we have an enormous cushion that will prevent us from taking a loser. You have a limited upside, but you have significantly limited downside. And the other goal that we have is to protect our capital. In fact, that's the first goal that we have in trading. Number one, we want to make sure that we don't give up any of the capital we have in our trading account. We protect our money. And then our second goal is to use that money to leverage a strategy that's going to bring us in 80 to 85% winners. So we really do protect our downside, protect our hard-earned capital. Now, as I said, we can profit if the stock price increases, decreases, or doesn't move at all. So we have a very high probability of making money. I'm going to show you sort of the secret sauce to how you take these trades. And I tell you, I mean it. I have 2 blockbuster trades going out on Monday. Now you have a limited loss potential, so you never worry about the trade blowing up if the market does take a huge move against us. And the strategy is very formulaic, which is very important. One of the things that we must do when we trade is we need to eliminate our own innate personality traits. We want to trade totally objectively using an optimized strategy so that we eliminate our really, it's sort of a a personality trait that each one of us acquires and is slightly different. And we want to stay very, want to adhere to all the principles that I'm going to show you. Now, a credit spread simply involves trading two components. It's a two-legged trade. And like I said, I don't like to trade spreads, but trading credit spreads is exceedingly advantageous. Now, I don't know if you knew it or not, but there are actually 5 directions. Now I have the chat open and I can see if you ask any questions. I'm going to wait to answer them until the end because I see questions coming across. I will answer them when the session's over. Now there are actually 5 directions that a stock can take. It can move sideways in a consolidative manner, so that over the course of the time that we hold the position, it doesn't move up to any significant degree or down to any significant degree. Now it can take a mildly bullish or a mildly bearish trajectory, or it can take a big strong bullish move or a big strong bearish move. So we have to anticipate what we believe the underlying stock is going to do before we take the trade. Now, like I said, we don't even have to predict right in order to make money. But if we do predict right, we're going to make an optimal amount of money. Now, if we believe that the trade is simply going to move sideways in consolidation, selling credit spreads is a way that you can make 100% of your credit. If you believe it's going to make a mildly bullish move or a mildly bearish move, you're going to make 100% of your credit. Now, if it makes a huge bearish move or a huge bullish move, you're obviously going to make 100%. But those kinds of trades would have been better served if we had traded a call or traded a put. But if we're wrong and we have a bullish anticipation of a move or even a consolidative move, and the stock makes a strong bullish move, we're still going to net 100% of our credit. So really gives us a lot of latitude on the trade. Now, I'm going to ask everyone out there, just to make you think a little bit, do you want to be a buyer of options, and when do you want to be a seller? I sort of put in the answer already, so I'm not going to throw it out there. But credit spreads are positions you sell, and for selling them, you're going to receive a credit to your account. Now, as the trade progresses, it will determine how much of that credit you get to keep. Now, optimally, you want to keep 100% of it. But if you only get to keep 85% or 90%, you've still made a really juicy amount of money. Now, the question is, when do you want to be a buyer and when do you want to be a seller? Now, put yourself in sort of the position of an auctioneer. Now, obviously, you want to be a buyer when the price of the option is exceedingly cheap. But if the price of the option is really expensive and you want to take a position, it's going to cost you a lot of money, and therefore you're going to have to risk a lot of money to get into the trade in that direction. I was looking last night at options on a particular instrument and they were they were options on the VIX, and they were super expensive. And I was looking at selling a credit spread. Now, when the options are very expensive, if you put yourself in the place of an auctioneer, do you want to be in the audience bidding on the item or the option, or do you want to be the man standing up in the audience with the gavel auctioning off the position? Now, obviously, if what's being auctioned off is exceedingly cheap, then you want to be sitting in the audience and you want to be placing a bid and trying to buy the option at the cheapest price possible. But if the item or the option is extremely expensive, you want to be the auctioneer and you want to sell it to someone in the audience for the highest price that you can get. Linda, I'm gonna show you exactly how you know whether the option is cheap or whether the option is expensive. There's a very easy metric to look at on an options chain, and I'm going to show you. Now, when an option has a significant amount of intrinsic volatility, that option is going to be expensive. And I'm going to show you how to check that. If you look in the options chain, there's going to be a metric called IV, and that's intrinsic volatility. And when the IV rank is high, you're going to want to sell it. When the IV rank is low, you're going to want to buy it. And I'll bring up, if we have time, I'll bring up my Thinkorswim platform and I'll show you exactly what I mean. Now, if you buy an option, or you sell, when you sell an option that has a tremendous amount of intrinsic volatility, our anticipation that as the trade matures, that arrow is going to start heading into the option. It's going to hit it. Volatility is going to leak out of the option. And all of a sudden, the value of that option is going to just collapse. Now, remember, when we sell the option spread to someone else, we have the obligation at expiration to purchase it back. Now, the optimal outcome is that the spread that we sell is worthless. So we just let it expire and we keep 100% of our net credit. Let's say we sell it and we receive $200 of credit. And as we head towards expiration, it winds up being worth 10 cents or 10 bucks. So we're forced to buy it back for $10. We accrued 200 when we took the trade. So for every spread we sold, we make $190. Now, what's very unique about this strategy is that we have time on our side, because time erodes the value of an option. In every other case, when you buy an option, no matter what type of trade you take, theta decay or time decay works against us. When you sell an option, as you move towards options expiration and theta decay starts to erode the value of that option, that's exactly what we want to happen, because we don't own the option. We sold it to someone else. And what they're doing is they're holding on to an item or an option spread that is becoming cheaper and cheaper in value. So hopefully it's going to be worthless when it comes time for us to exercise our position. But if we have to buy the position back at 10 cents or 20 cents or even 30 cents on when we sell it for 200 bucks, we'll keep the 200, the 190, or the 180 per spread. And normally on a given trade, you can trade 3 to 5 options. It all depends on the amount, 3 to 5 spreads. It all depends on the amount of risk you want to take. So the cost is low and implied volatility is low. The cost of an option is high when implied volatility is high. Every single option chain comes with a value called IV. And hopefully I have an opportunity to show you that on the Thinkorswim platform. Now, let's take a look at a bearish credit spread example. And this is Abbott Labs. This is a platform that I use. It's a very simple platform. I use it I don't use it on Thinkorswim. I use it on a brokerage company where I have money called First Trade. And it's very simplistic. But what it does is it allows me to see the trajectory of the trend. Now, the trend on Abbott Labs here is clearly to the downside. Every time we get an upward retracement, now I didn't put the 15 period EMA in here. Every time price comes up to the 15, it heads down. Up to the 15, down. Up to the 15, down. Up to the 15, down. We're making a series of sequentially lower lows and a series of sequential lower highs. Now that starts changing a little bit here, but it still hasn't broken our 15. And when price moves up to the 15, our anticipation is again a move to the downside. So we're taking a really strongly bearish position on the trade. So what are we going to do? We're going to sell the 50 delta call and buy the 25 delta call. Now I'm going to give you all these trades, so you don't have to worry about sort of trying to find them. And as part of this program, we're going to have educational sessions, or I'm going to teach you how to find these trades on your own. Now I have a scanner in First Trade that you can get by opening up an account with First Trade. It's located in Manhattan. It's a really solid brokerage. It's not like Thinkorswim. I don't use it to trade, but I like their charting platform and I like their scanners. So I open up an account with 50 bucks. They never take any of the 50. It just sits there. You know, it accrues about a 3% interest because it's a money market fund, and I get access to these tools. But you don't need them. You can also use Thinkorswim, which is much more sophisticated, but I like their scanner. Now we're going to sell the 98 delta call, and we're going to buy the 25 delta or the 103 delta call, and we're going to accrue a net credit of $207. Now, I would never take a spread with this kind of risk. And all these metrics you're going to become acquainted with. And I'm telling you, in a very short period of time, they're going to all become second nature to you. When you're exposed to them for the first time, they may seem a little bit daunting, but trust me when I tell you, they're really, really easy. And in the educational sessions, I'm just going to sort of beat the drum on them. Now, the trade has a $5 vertical width. The spread goes from 98 bucks to $103. Now, we're going to collect $2.07 on a $5 vertical width. I don't like that vertical width. I just use this as an example to show you the metrics on the trade. Because on this trade, you're going to look to make 207, but you have to risk 200, and the number's right up here. You can make 207, but you have to risk 292, or not 293. I don't like that risk to reward. I'm going to show you how we completely reverse that. But I want to show you how the trade operates. Now, with these metrics, when we sell the 98 delta call, as bad as these metrics are, they still give us an enormous cushion on this trade. Now, we sold the 98 delta call. So if the stock trades below 98, we're going to make 100% of our net credit, which is $2.07. We're going to keep 100%. Now, remember what I said. Now, I just want to sort of digress for a second, because you hear a lot of traders throw out there these 500% and 600% winners. They also have two catch phrases because they're marketers and not traders. I'm a trader, I'm not a marketer. And so I never tell you that trading options is simple and that you're going to make this enormous amount of money. Actually honing in on the right stocks to trade to get a tremendous percentage of that vertical width is tough, but I do it for you. And I spent the entire morning from 7:30 this morning until a half an hour before the start of this webinar, finding unbelievable trades that give us 50 and 60% vertical widths, so that the risk to reward is amazingly tilted in our favor. But even with this poor vertical width, if the stock trades below 98, and we only have to have it trade 1 cent below 98. In fact, it can trade right at 98. We make 100% of our potential profit, or $207. Now, let's say the trade moves against us and it trades between 98 and 107. Now, we got $207 of credit on the trade. So we have $2.07 of upside leeway. So if it trades between 98 and $100.07, we're going to make some part of that net credit. Not 100%, but something. And we're going to walk away at the end of the day with the trade in the green, and we're going to bank money on the trade. That's our goal. We want to make 80 to 100% on every trade. That's my goal. Now, if it trades between $100.07 and $103, we're going to take a partial loser. Now, this should be 200. I'm sorry for doing this, but our risk on the trade is 297. So we're gonna, the loss is going to be between 0 and $297. I'm sorry, this number's wrong, but we're going to take a partial loss, not a complete loss. And that's going to be extremely rare. And then once in a blue moon, we're going to lose our entire width, all of our cushion. It's going to trade above 103 in this particular case, and we're going to lose all of our net credit and then some. Now, it's going to be impossible for us to do that on the way that I configure the trades. Now, I know this is a lot of numbers, and I know this may seem overwhelming, but I want you to understand at least the fundamentals of the trade. I don't want to black box the system to you. just show you winner after winner and show you numbers and not give you the fundamental understanding of what we're trying to do. Like I said, I'm a trader. I'm not trying to market a system. I don't want to show you a black box system and just tell you we make it this great amount of money. I want to give you a fundamental understanding of what we're trying to do. Now, here's the vertical width on a trade. Now, if we get 33% of that vertical width and risk 67% of the vertical width, and we need to get 67% winners to break even. And that's what we're going to do. The market's telling us that because we're trading deltas. And deltas tell us what the market anticipates the stock is going to do. So if we wind up with 67% winners and our vertical width is 33%, we'll make a buck, we'll lose $2. Make $1, lose $2. Make $1, lose $2. So in order to make money, we have to trade above that 67% win rate. Now, if our vertical width is 41%, actually 40% is the way that it's configured here, we only have to get 60% of our trades to make money, because we're going to lose $2, and if we make 1, we make $1.50. $2 loss, we make $1.50. We make $2, we lose $1.50. So here we have a much better risk to reward. Now I'm going to look for vertical widths that are 50% or more. So we have a risk to reward that's 1-to-1. We only have to win 50% of our trades, and we're winning 85% of our trades. So over the course of time, we're going to accrue a substantial amount of money. Now, here's a trade I took on McEwen Mining. These are the kind of trades that I'm looking to take. And what I did was I sold the $7 put and I bought the $6 put. Now, when you sell puts, you're bullish, and when you sell calls, you're bearish. And you're always going to sell the 50 delta and buy the 25 delta. So I sold the 50 delta $7 put, bought the 25 delta $6 put, and my net credit was 45 bucks. So I had a $45 vertical width on a $45 on a $1 vertical width trade. So for every $45 I stood to gain, I risked $55. I only have to win 55% of my trades in this scenario in order to break even. If I make 75% of my trades, or 85%, which is the rate we're going, we're going to make an inordinately large amount of money. Now, here's that $7 level. That's the put I sold. If the trade closes, or the underlying stock closes at $7, and now it's trading at $7 at the time I take the trade, because that's the 50 delta. If it closes at $7.01, we make 100%. If it trades at $7, we make 100%. And we have that $45 window all the way down to $6.55 on a $7 stock, where we're going to make some percentage of the credit we received on the trade. So it's got to trade below $6.55 for us to move into the red. And I'm not going to allow that to happen, because we're going to set a stop that takes us out of the trade when we hit the maximum amount of money that we stood to gain on the trade. So we're going to have a 1-to-1 risk to reward ratio where we only have to win 50% of our trades. And we're going to, and like I said, we're going to win close to 85%. Now, if you look at this is a year's worth of trading on one instrument, and this is the communication sector. Now, I take some iTrades and some Spider sector trades. They're very, very advantageous. I have yet to lose a sector trade. And in the course of the last year, I think I took close to 10 of them. Every time the sector trades back to the 15, I go long. Back to the 15, I go long. Back to the 15, I take a bullish credit spread. Back to the 15, bullish. Back to the 15, bullish. Now, we're going to lose the turn, but we're only going to lose what we stood to gain. And then we're going to start, every time it retraces back to the 15, we're going to sell a bearish credit spread. Back, sell a bearish. Back, sell a bearish. Back, sell a bearish. And in multiple places in between here, you could have kept selling them. I wait till it retraces back to the 15 EMA. That's sort of the metric I use, because that really diminishes risk on the trade. So you can see, you take the long-term view of the trend. Every time it retraces back to resistance on a long, support, down to support on a long, or up to resistance on a short, you can sell the spread. You could have made a whole year's worth of profit just trading the iShares communication and iShares, the iShares communication and iShares tech. Now, here's the formula. It's such a simple formula to follow. You sell the at the money and you buy the out of the money. So you're going to sell the 50 delta and you're going to buy the 25 delta. And we're going to do that over and over and over again. That's what takes emotion out of the trade. It takes your gut feeling out of the trade. It takes your personality traits out of the trade. And believe me, that's what kills a lot of traders. It's their innate tendency to take a trade with an inordinate amount of risk on different metrics with different configurations. We never vary from this formula. Now, if we're bullish, we sell puts. If we're bearish, we sell calls. Here I wrote we want to collect 1/3 of the vertical width. We want to collect 40 to 50% of the vertical width. Now I have a scanner. Now the scanner's in First Trade. So I can't offer it to you, but every Sunday, I'm going to give you the results of that scanner on a PDF. Now, the truth of the matter is I rarely use it, but it's going to give you this trade based on the percent of the vertical width you would get. If you sold a bearish position on UPS, you would get a vertical width that was 41% of the vertical width. Now, on this particular trade, this is on Wayfair. I'm sorry, I'm going to move to this one. Here's XLV. That's healthcare, and that was bearish through most of the year. That was a defensive sector. You would have gotten 43% of the vertical width. That's a decent vertical width. And that's the one I actually showed you in the example. Every time it traces back to resistance, you're going to sell it. Your vertical width is going to be 43%. So all you have to do is get 57% winners on these trades, and you're going to wind up trading in the green. So we know exactly the win rate we have to achieve in order to create profitability. It's really, really formulaic. I mean, there's very, very little left to chance. That's that's the way you want to trade options. And unlike other strategies where you have to set a target, we do set a target here, but the target is really variable, because really what we want to do is we just want to have the options we sold to someone else expire worthless. So really, what is our target? Is let the whole thing that somebody else is holding go to zero in value. And we have time decay on our side. So as the option turns the corner into expiration, we know that it's going to just wither in value, and the amount of credit that we're going to get to keep on the trade is going to jump astronomically. Now, this was a trade on IBB. This is now BlackRock creates all the iShares sectors. And here is a bearish trade on BlackRock. As the scanner pointed out, it had a 40% vertical width. And it was bearish. So since it's bearish, you're going to sell the 50 delta put, and we're going to buy the 25 delta put. Now, the critically important metrics on a spread I'm going to give you on every trade. Obviously, I'm going to tell you our anticipated direction, and you're going to know that right off the bat. Now, if it's bullish, like I said, we're going to sell a put spread. If it's bearish, we're going to sell a call spread. We need to know the expiration date. It's critical. We need to know the two arms of the trade. We're going to sell one put, buy one put, sell one call, or buy one call. We want to know the premium. The key is the premium width, which is equivalent really to the premium percentage. The IV rank is critical. We want to sell spreads that have a lot of implied volatility factored into them, so they're really juicy. They're not options we want to own. They're options we want to hoist on someone else, dump something expensive, let someone else eat the cost. And we believe really strongly on the trajectory of the stock that we're trading is going to continue. And if we take a bearish position, the stock is going to continue to move in a bearish direction. But if it doesn't, we still have a really nice cushion. If it's going to move bullish, it's going to continue to move in a bullish direction. Even if it moves somewhat against us, we have a nice cushion. And again, remember, if we take a bullish position, it's got to move 1 penny in our direction or just trade sideways, and we get 100% of the credit we received at the time we took the trade. We get to keep all of it. Now, here's the formula again. We're going to sell the 50 delta call or put. We're going to buy the 25 delta. Now, I made these slides a long time ago. We're looking for a 33% vertical width. We're going to look for a 40 to 50% vertical width. So we only need to achieve about a 50% win rate to really, really crank in money. Now, when we start moving into the 7 to 14 day expiration period, a lot of times I will close the position because we get what's called gamma whip. And gamma whip means that just a small incremental change in the underlying value of the stock causes a really large change in the value of the credit spread. And we don't want that to happen. We want sort of the move on a credit spread to be muted. But as we move towards expiration, we lose that. So let's say just, we're 7 days towards expiration, we're up 100% on the trade. If it stays where it is, we're going to net that 100% credit. Now, I know this, I'm speaking a lot, I'm giving out a lot of information that you may not quite grasp yet. I promise you, you will, as long as you have a fundamental understanding of what we're looking for. And I'll give you an example. It's a trade I took. And I usually don't throw out metrics, but it was a bullish trade I took on Walt Disney, which at the time had a lot of implied volatility. And I was trading the day of options expiration. I was up 100%, 99%, because I had 1 day left on the spread. And a boutique, a really small brokerage did a hit piece on Disney, and Disney took its biggest single day loss in 20 years. I lost $40,000 on the trade. Don't let that number scare you, because I didn't set a stop. This was many, many years ago as I was learning how to trade this formula. And I will never let a trade go right into, if I'm up 99% on the trade and I can buy the position back, say I sold it for $4 and I can buy it back for $3.98, I'm going to do it. I'm not going to let it go to that last day because I didn't have any time. Now I didn't go into how you can put band-aids on these trades, how you can salvage these trades, if they move against you. There's many, many ways that we can move that can turn a loser into a winner. We did that with Lockheed Martin, and I'm up an enormous amount on Lockheed Martin. So there are many sort of ways that we can take a credit spread and we can apply a little bit of antibacterial cream on a trade that goes against us and ultimately still create a winner out of it. But if we let it go right into expiration, we lose that advantage. Now, what I generally look at when I trade is I look at what is the best performing sector. So say it's energy. Then I'm going to look at the best performing subsector within energy. At the time I created this slide, it was the oil services and the drillers. Then I'm going to look at the best stock within these subsectors. The one that is either bullish or is trading long or short with the greatest momentum and gives us the greatest percent vertical width on the trade. So it's trading with the greatest amount of implied volatility. That's the stock I'm going to grab. That's the stock I'm going to configure, and that's the stock that is the option spread I'm going to send out. And I just want you to know this is something that I don't think anybody can claim. I trade everything I send out. If I send the trade out to you, I'm in the trade too at the same price. And I'll just tell you a quick story about what's going on in the portfolio right now. I'm looking to sell a credit spread on the VIX. Now I set a net credit of 72 cents on a $1 wide. I mean, do you realize the kind of advantage we have on that trade? We will get $72 of net credit on $38 of risk. It's an unbelievable trade, but we're a lot of people in this service right now. Yesterday, the net credit sat at 71 cents for 4 straight hours. I sat here because I was doing other things. I watched it on Thinkorswim. It sat at 71, 71, 71. The market makers saw all of us out there looking for $72 in net credit. They wouldn't give it to us. They kept it at 71. Now it retreated a little bit, but it's still an open trade, and it's one you're going to grab if you come aboard the service. You're going to get $72 and only risk 38. On a trade like that, you only have to win 38% of your trades in order to trade at break even. You trade 50%, 60%, 70%, or at 85%, you're going to make bank on the trade. It's still an open trade, because yesterday it went to 71 and we couldn't get filled. Now here's how the scanner looks. I'm going to let you see it every Sunday, but very rarely are you going to see that I take a trade off the scanner. I find better trades than the scanner provides us. And what it does is it looks at the vertical width. Here's the premium or the vertical width, 40% all the way down to 34%. To me, these are unacceptable. Maybe around 40% I'll take, but I'm looking for 45% at a minimum on the trade. That was the one that we had on McEwen Mining, the one that I showed you. That's where we're going for. Now, here's another trade that I took on Vertiv Holdings. Now, it was a put spread, so I was bullish on the trade. Now, Vertiv went on to just continue to the upside. It still has not stopped. Now, today, it might have gotten dented a little bit, because the last time I looked, I left my phone someplace. I don't know where it is. But Vertiv, all we needed Vertiv to do was to trade at 42.50 for us to collect 100% of our net credit. It's trading right now around 51. So I sold the 42.50, the 50 delta. I bought the 37.50 put or the 25 delta. Now this is a 37, 8, 9, 40, 41. This is a $5. I got a $2. That's a 40% vertical width. It's a $2. The vertical width is 40%. I bought it back to close at 30 cents. So we made $170, 85% of our potential credit. With trades like this, all we need to win is 60% of our trades. Now, this is wrong. I put in, we had 17 winners, 3 losers, and 14 winners since I formulated this trade. And actually, I was a little bit confused about the webinar today, so I didn't run in and update this. We have 1 additional loser and 5 more winners. So I've pushed the win rate up to about 87%, and that's where we stand in the portfolio to date. Only we've taken more than 20 trades now. We've taken 25 trades. And I can tell you the loser I took was on Palantir. And it was not a big loss. That's the key. Now, those that can do and those that can't do, teach, or those that can't do, sell it to you. I take every trade I send to you. If it's not good enough for me to take and trade, it's not good enough for me to send to you. Now, you have all these gurus and all these self-anointed guys who've made $800 million, who take 600% trades overnight, but they will never tell you or guarantee you that they take them in their live money account. If you challenge me, I will send you a snapshot of my live account. The only thing I cannot do, obviously, is give you my account number, and I do not want you to know how many spreads I trade. But otherwise, you can Thinkorswim will show you it's live, and it will show you the execution price. It'll show you all the metrics that I send to you. It could be very advantageous for me to get in ahead of you, There's a lot of people taking these trades, but I don't do it. It's not illegal because this is an educational service. And the trades that I send to you are meant for educational purposes only. So if I get in ahead of you, no harm, no foul, but I don't. I take the trade with you. I never execute it beforehand. Now, I think I'm gonna have enough time. Let me see. It's, I'm gonna have to, 2 or 3 minutes. I'm gonna show you really quickly. Now, I put 2 optimized credit spreads are sent to you to your email inbox every Sunday. Now you're gonna get 2 this Monday. I already have the trades picked out. The vertical widths on these trades are gonna knock your socks off. You're gonna get the entry price, exact entry, the stop, the targets. And I'm gonna give you I must have sent out probably 15 emails this week. I sent out 2 this morning, for 2, one for the credit spread service and one for my option service. So you're gonna get multiple intra-week updates. If anything takes place that we need to know about, you're gonna be updated. You're gonna get my bi-monthly live credit spread training education only for members. There's not gonna be a general invitation sent out to people who are not members of this service. So all the metrics that I took that may be a little nebulous in your head, may be unclear, I promise you will become crystal clear. And if you really, really like this strategy, I love this strategy, you're gonna find yourself, if you trade Thinkorswim, what I do is I sit at night. I sent out an alert newsletter this morning at 4 a.m. in the morning. So help me God, because I was sitting in bed, going through my phone, looking at all the trades, and came across this credit spread trade in my Thinkorswim app on my phone, and I jumped out of bed to make sure that everybody would have it in their trader when they woke up this morning and had an opportunity to get into the trade. And you know what? It executed this morning at an unbelievable credit, vertical width. You're going to become a master at trading these, I promise you. Now, we're really giving you, I want you to come aboard at a very, very advantageous low risk price. The first month is $49. If we get the first trade I take is a winner, which is very likely to be the case. You got an 85% chance that's going to be the case. It will pay for your 49 bucks and then some. It'll pay for your 628. And you'll notice I modified this because this is our holiday special. This is our Christmas, New Year's special, down to $628 for the year. Now you have to put in the coupon code SAVE70 for the month and the coupon code SAVE 55% if you want to buy the year. Now I think that's the end. Now all I'm going to do now, the coupon code for the annual, I'm sorry, is SAVE 50%. You leave it to me to mistype it. I'm sorry. Okay. So the coupon code for the annual again is SAVE 50%. For the monthly, it is SAVE $70. So just lock in whichever you're interested in, lock that into your head. And just remember to type that into the coupon code section when you check out. And I'm going to answer all the questions. Now, what I'm going to do is I'm going to drop this. And what I'm going to do is I'm going to bring up my Thinkorswim platform for you. We have a couple of minutes. I'm going to show you. It's give it a minute. It will load. Here we go. I have to just pull this off because obviously I'm not going to put in my username and password. It's opening. And here we go. Now, I'm going to show you a trade that I looked at this morning. Now, I'm not sure this is one that I'm going to take, but let's take a look at the chart. Now, let me take out all the drawings, all the drawings that are right here. Where's remove drawings right here? Just clear the drawings head. See, I didn't know that I was going to do this, so I don't have the time frame set up. Let me change the time frame. I'm just going to go to a much more standard. We don't need 180 days. Let's go to 30 days, and let's go to a 20-minute candle. So here's Palantir. Now you can see what's happened to it. And this is the loss we took on Palantir. This is the first, we had 5 winners and we had a loss on Palantir. But we didn't take a big loser because we had to stop. It's heading down, and now it's coming right back up. Right here. Now, if we go, now, if we add a few indicators, you're going to see that it's trading right off the 15 EMA, right here. It's trading right off support. Only it's hard to. I wasn't planning on doing this. I don't have the chart set up, but I'm going to show you when you go to the trade what you're going to do. I looked at the February 16, 24. And let's look at the February 16 right here. Now the 17 is actually the 18 now. See, it's changed since I took the trade because Palantir has changed in price. So we're going to look at the puts because we're bullish. We look at the delta, it's 51. Look at the open interest. It's gigantic. We want to trade a liquid call. So the delta here on the trade, 50 is 18. We're taking it slightly out of the money, but we're going to sell it. And then we're going to buy. We have a 23 delta. That's good enough. We're going to hit the buy button. So we have a $3 vertical width, and we make $1.32 on the trade. That's our credit. Now, I don't know if that's acceptable or not. Since it's a $3, $1.50 would be 50%. We're trading around a 40% vertical width. It's okay, but that's how I look at the trades. I go from trade to trade, but I have these stocks on my hit list and they're super easy to configure. If this is the trade I want to take, I can always ask for a little bit more because this is a limit and go for $1.35 or even $1.40, thinking that we'll get a little bit of wiggle room, and then I can confirm and send. Now, $1.40 on a $3 vertical width is approaching 50%. That's how easy they are to configure. It's a matter of knowing what stocks to look at. I'll show you one more that I'm looking really closely at. Oh, I just hope I remember the ticker. I never go anywhere without my phone. And for some reason, I just walked out without it. Here, no, Oh man, I don't want to run and try to find my phone. It's Bosch and Loam. Um, and I just don't know the ticker here. Let me see if I can find it. It'll come up for me. Oh, it's not. But Bosch and Loam gave me an unbelievable vertical width on a very near dated spread. So these are what I look at. It's very, very, very easy to configure. I just wanted you to see how simple they are. Now, here's implied volatility right here. Here's the IV rank. And what you really need is not the IV rank of an individual option. You need the IV rank of the spread. Now, the only way that you can get that directly is by calling the broker. But if you look and you get a vertical width that's between 45 and 50%, the only way you can do that is if the IV rank is inordinately high. And just by looking at the options numbers here, you can just get a gut feeling that Palantir, which I haven't taken out yet, is trading with this huge amount of implied volatility. Anytime you start moving into the 60s and 70s, that implied volatility is exceedingly high. I mean, if you look at Walt Disney and some of the commerce stocks, you're going to see IVs here, implied volatility, that are very low. Now, I'm the one who configured this. That's why the delta is first, implied volatility is second, open interest is third, and gamma is fourth, and theta is fifth. Those are the key metrics we use when we take a trade. We want high implied volatility. We want a liquid options chain, so we want open interest to be high. We want the gamma to be very low. We want, obviously, when we take the trade, theta is going to be small, but when I open up the platform as the trade matures, I want to see theta start to rise, 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 and rise. Now, Vega is not important on these trades. So let me go to questions. I'm telling you, all this is going to become very, very easy to understand. And I know this is a little bit different than what you may be used to seeing. Just going to rotate the slides. But I want you to understand what we're doing. Okay, let me go to the questions. Hey, Linda. Okay, I sort of already answered your question. It's implied volatility. The IV ranks that we're going to capture, when you see the trade that I send out to you, I'm going to include the IV rank of the spread. I'm going to get that absolute number from the broker. You're already going to know the IV rank is incredibly high, because if you have a vertical width of 45%, you could never achieve that without trading super expensive options. Those are options you would never want to own. You'd only want to sell. And if you did own them, it would be very disadvantageous. And let me just give you one other perspective. What makes this so advantageous? Let's say you bought Palantir with a high implied volatility and you took an $18 call. And let's say you had to pay $2.50 for the call. So in order to make money at options expiration, Palantir would have to trade not only through your strike at 18, but the $18 call, but you'd have to trade the $2.50 you paid. It would have to trade above $20.50. If you sold it, all it would have to do was trade at 18, and you make 100% of your credit. That's why it's so advantageous to sell an expensive put or call than it is to buy it, because it doesn't have to move. And I'm telling you, Palantir has a mildly bullish trajectory after that big drop. There are so many metrics I looked at last night on Palantir. Hey, David, when we sell a credit spread, does our broker require additional funds? No, they do not. Because remember, your downside risk is fixed. So your broker is not going to require you to, to put in any more money. That has to do with your the size of your portfolio. And here's a metric that's exceedingly important. Let's say, and I'm just pulling this number out of my hat. Let's say that you can afford $500 of risk per trade. And it could be $250. It could be $200. It doesn't matter. I'm just going to say $500 of risk. So you take a trade like on an MUX, for every $45 you could make, you could lose 55. So you take the 55, divide it into 500. I don't know exactly what that is. It's obviously like probably about 9 spreads. That's going to give you the maximal amount of risk that you can take. You're willing to accept 1,000 of risk, and on 9 spreads, if you get that $45 width, you're going to make 9 times 45. 9 times 4 is 36. You're going to make 9 times 5 is 40. 36. You're going to make $400. My math is terrible without a calculator nowadays, but you're going to make an enormous amount of money per spread. So, but you do not need extra money from your broker because you're not taking a trade that has infinite risk. BLCO, oh, Michael, I'm sorry, I closed it. I'll look at it though. Let me write the ticker down. And let me tell you, some of the best trades I get are from some of the people who already subscribe to the service. They send me tickers all the time to look at. And some of them are really outstanding. I have to tell you, I get some great trades from my traders. Excellent discussion. Can you show equity curve? You know what, Blake? I don't have one calculated. I really apologize for that. And I could have done it really, really easily right off my phone. And I just promise you that if I showed you the equity curve, you would be very, very impressed. I don't like to throw out numbers because I have a very, very big portfolio. And I trade, and I'm able to trade with a significant amount of risk. But here's what the thing, I'm going to send these two out to you as part of the service. I'm going to attach it to the letter. You're going to see the equity curve in my live money account. But what I do is I take off the right edge, or I convert the right edge into a percentage. Now on my phone app, it allows me to do that really, really easily. I don't want to do that in my Thinkorswim because remember, I'm trading 3 strategies on Thinkorswim. I own stocks, I own credit spreads, and I own calls and puts. So whatever equity curve you saw is not going to be the equity curve you would make off this service alone. On my phone, I can do it. It's really a lot simpler. I just don't know how to do it on Thinkorswim to factor them out. And the reason I can do it on my phone is I have each of the strategies segregated into different portfolios. So the curve that's generated is based on the strategy. So I have my percentage on my stocks that I own, and I don't own many, I can tell you that. Most of the stocks are in a Roth IRA, not in my trading account. And I'm just going to hold them. The calls and puts are in a separate section on my phone, and the credit spreads are in a separate section. But we're up. Every number I gave you is accurate because you're going to see every trade if you subscribe. The thing I also do is I put every closed trade on the newsletter. I don't hide anything from you. So you're going to see, I told you we took a loss on Palantir. You're going to see it. I told you that we took either 4 or 5 winners before. You're going to see those 4 or 5 winners. We took a winner today on IUPath. ticker PATH. We took a nice winner today. Took it off the table. That's the one I sent out at 4:00 a.m. in the morning. I'm turning the corner on expiration. I wanted to get it out. I was worried if I sent it out, after the open, we might not hit it. It executed on my platform. I'm sure it executed on everyone's. We were out of the trade. And I did it early so that this market collapsed just because it was a bullish trade, did not affect us. We were out and banked the trade. And now that the market is sunk, we are in the bank. Thank you so much. I really appreciate it, Blake. So for $49, that's about the amount of risk you're going to take. And like I said, I take every single trade in my real money account. And let me tell you, I trade quite a large number of spreads because I spend a lot of time finding them. So listen, everyone, have a really, really happy new year. Safe, happy. Now 2024 is going to be a very unique year. And I'm telling you, we're going to hit it out of the ballpark. I just want everyone, we still have a lot of traders in the room. I would like you to tell me, and this is just for academic purposes, what sector you believe is going to be the #1 performing sector for 2024. And there's a lot of smart guys in there. I see a lot of people in there are members of my service. So just let me know. Give me a guess. Tech, communications, utilities, energy. What do you think is going to be the #1 performing sector in 2024? And I'm going to tell you what I think it is. And I believe I'm going to be very accurate. Come on, give me a guess. Okay, chips, energy, financials. Any others? Okay, I'll tell you what listen, all of them are good. All of them are good guesses. Now, first of all, Steve, on chips, I think we've maxed out on chips. On a percentage basis, the FANG ×3 stocks, they're still going to go higher, I believe, because interest rates are going to be sequentially dropped. But I think they're not going to be the optimal performing sector, but it's going to be a strong sector. Financials, David, is a terrific guess because of the fact that we have sequentially dropping interest rates. Money is going to be cheaper to borrow from the bank, which means although the bank makes a little less money, the volume of business they do is going to be significantly higher. Financials are going to be very strong. Now, energy, Michael, is going to be a weak sector. We may actually hit $50 a barrel of energy because I do think that we're going to have a little bit of economic contraction. But in my opinion, and listen, this is just based on the things I've read, the research I've done, I believe it's going to be healthcare. iShares, it's XLV. I think that's going to be the #1 performing sector. It's not only defensive in nature, it also can be very bullish. And we're going to look for a lot of great trades. One of the trades going out Sunday night is on a medical device company. That is a strong buy. All the brokerages have it listed as a strong buy. Earnings per share, it's going to have an earnings beat. We're not going to trade into earnings though, but I think that healthcare is going to be really strong. And David, it's going to be followed up by financials. Chips and communications, which include, now communications, and this is all educational. It's not even part of the webinar. Communications includes Facebook, Google, Netflix. Then you get T-Mobile, Verizon, Comcast, all the techs you would expect in communications. But XLC, iShares Communications, has those stocks in that bucket, not in communications. Hey, David, in your biotech alerts, so let's hope so. Okay, Well, David, I have a great biotech alert. I have a new cash catalyst coming out. And I'm telling you, 2024 is going to be the year of the small, is going to be the year of the small cap, and all the trades I'm sending out Sunday night are small cap stocks. Please put a link for the services in the chat. Sure. Hey, Rory, can you put a purchase link in? Hold on a minute. Let me make sure that Rory is there. Before I close the room, I want
Yeah,
to.
yes, Mark, I did. I put the link in the chat box.
Okay, Derek. A link is in the box.
Put it again real quick for him, Mark.
Rory's going to put it again, and I appreciate Rory. So listen, I already see quite a few people who have come aboard. I'm not going to yell out your names. Like I said, I'm not a marketer. I'm a trader. I really appreciate it. You're trading along with me. I'm not selling you a service. I'm giving you something that I trade with you. I am in the same canoe. So if the service loses money, I lose money, and I can tell you, I don't want to give these rotten market makers or somebody else my money. So again, have a really, really happy new year, safe and wonderful, and let's make 2014 our banner trading year. And I really believe, based on what I see, and I'm not, blowing smoke, 2024 with these sequential rate hikes are going to make financials, healthcare, terrific sectors. We're going to have percent gainers there, and that's where I'm going to focus. And then we're going to look at subsectors within the financials, whether they're regional banks or the big banks. We're going to take some stellar trades. Everybody, thank you so much for your time. And again, Happy New Year. Bye-bye, everybody.